Hello everyone, welcome to Microeconomics. Today's session is regarding interest rates, economic rents, and profits. I'm Professor Bias and thank you for joining the session today. Interest rates are well known and are highly used in all financial markets. And essentially, interest rates are the price paid for borrowed funds and or any interest return on capital investments. Most of us are either paying interest rates on certain things. For example, when we get a credit card, we have to pay back the funds with an interest rate. Or some people that invest in capital investments or financial investments receive interest return or net returns on their investments or capital financial returns. Interest rates are very common in today's economic sectors or economic institutions and economic returns. There is a loanable funds, and the loanable funds are typically funds that someone borrows and another person lends. We have a loanable funds market where the lenders meet the borrower and vice versa, and there are financial institutions now that facilitate lending. The borrower must agree to pay some form of interest rate to the lender, and the lender must agree to accept the interest rate, or typically the lender sets the interest rate. Or in economics, the supply of loanable funds and the demand for loanable funds determine the equilibrium interest rate. But in reality, actually, the financial institution or the lender may set the interest rate based according to the demand for funds. So when we're looking at the interest rate, there is a supply of loanable funds, and typically the supply of loanable funds primarily came from savers, who are people who consume less than their income and deposit those savings in financial institutions. And those financial institutions supply the funds for loans, auto loans, commercial loans, business loans, home loans, mortgage loans, etc., or credit card loans. And then you have the borrowers that will go in, apply for credit and receive the funds in exchange for interest rate and to repay back. And most of the time, when you have high level of savings, you typically save it, and the financial institution makes it available for lending. Also, the savers may receive an interest return on their savings from where they had deposited. Sometimes it's very, very low, depending on where you save and where you deposit your savings. The financial intermediary will make those savings. They will hold some of them, and the majority will be lent out to someone that needs them. So we have the supply of loanable funds, which in this case, it could be upward sloping, or it is the majority of the time upward sloping, because often cases, the higher the interest rate that there is in the market, the greater the quantity supply of loanable funds that savers are willing to offer, since they're getting some potential interest return on their savings. The lower the interest rate, the less willingly people will be willing to supply loanable funds, or the less quantity supply of funds. So there is an upward relationship or a positive relationship with interest rates and loanable funds. The greater the interest rate, the greater the quantity supply of loanable funds, and vice versa. The lower the interest rate, the lower availability of loanable funds, because the suppliers are the ones that are supplying funds for lending, and they are the ones collecting the interest rate. And if the interest rate is high, they supply a greater quantity of funds. If the interest rate is low, they're not going to supply enough or significant quantities of loanable funds. So ideally, the supplier would like to get a higher rate and vice versa. If there's low interest rate, low quantity supply. Now, interest rates are very important, very critical. People demand funds for consumption to satisfy their spending, when their income is not enough for their current consumption. And there are the most traditional common ones, which is a consumption loan in the form of credit card loans or credit cards, plastic cards. And typically this type of loans are offered to the majority of the public. Starting at 18 years of age or so, any individual is offered their first credit card, $500 credit card, $1,000 credit card, 2,000, 10,000, American Express, etc. There's a lot of credit cards that offer you a credit loan for you to satisfy your consumption. And they have an interest rate attached to it that you have to repay back that base amount plus an interest as well. So most of the time, consumers use their credit card heavily. It's additional funds that you have available at an interest rate. And then we have what is called a positive rate of time preference. And this is the individual's preference for earlier over later availability of goods. Most of the time, if we don't have the money to buy a product, the store can offer you a credit to get that good, to get that product. So you want to get the good now, even if you don't have the income. The store can offer you the good at today and to be repaid back in the future with some potential interest rate. So we have what is called a positive rate of time of preference. You prefer the product now than later, and you may be willing to accept the additional loan or the additional credit to the store than if you were to wait until you have the income. It's better to wait when you have the income than to get it on credit and then have to pay back more with the credit on it. So you have the option to get a credit card or the credit card on the store. It's a good rule of thumb to not open credit cards in every store that you go to and that offers you the good now and pay later with the credit, because it lowers your credit. If you open a lot of accounts in different stores, it's a bad way to a bad way to start or to manage your credit. Have some, but not a lot of cards in every location. That's how credits are dropped. Credit scores drop when you open too many accounts in every location. And you go to a store, they offer you credit, and you take it. And you go to another store, they offer you credit, and you take it. Plus, you get in financial hardships, financial debt. Now, when we're looking at investment loans are typically used to produce goods and services and capital goods, and they enhance the productive capabilities of the economy and of a business. So most of the time, investors or small businesses or the private sector may receive investment loans that have lower interest rates than the traditional consumption loans, which I tend to have a high critical view on consumption credit card loans. You have a consumption credit card loan that typically has 21% interest rate, 15% interest rate, and that's still pretty high. The investment loans could be 5%, 7%, 10%, significantly lower. And because they are used to invest in capital formation and has the productive capabilities of businesses and so on. So be careful with your credit cards. Just as a rule of thumb, don't open too many credit cards or too many credit accounts everywhere you go. You could have 2 to 3. 2 to 3 credit cards is a good number with managing your credit effectively, keeping them at 50% or less in terms of your value that you have in them, and pay them back consistently. Otherwise, you're going to have to pay back the face amount plus 21% interest rate on it. And most of the public typically doesn't pay their credit card in full. Some do, the majority don't. A good amount do. So make sure to be responsible in terms of credit loans. So typically firms or businesses or individuals that are self-employed or self-entrepreneurs tend to use investment loans or what is called business cards in the form of an investment loan. And they produce capital goods and uses those goods to sell a product in the market, and may need to borrow funds to do so, to finance those activities. So they may have lower interest rates than the traditional consumption loans. Although some businesses do give you 0% for like 6 months, 12 months, 18 months, because they know that in the future you're still going to use that card and are now potentially going to pay within 6 months, within 18 months. Most people don't. Some do, some don't. Now, the loanable funds market is a very important market. We have the demand for funds, which are the public or the individuals themselves that are demanding funds to consume or to invest. Businesses, households, essentially the market. If you're demanding funds, you typically want to borrow them at a lower interest rate. So the demand curve will be downward sloping. The demand curve for the demand for loanable funds, or the demand for money, which is often referred to, it's downward sloping. As interest rates increase, the demand for funds are lower because you have to pay a higher interest rate. As the interest rates drop, the quantity of funds demanded increases because it's less costly. So if interest rates are high, consumers' cost of borrowing rises. So they may be willing to cut back on the amount of funds they borrow. And for the investors as well. If the interest rate is too high, their net rate of return will be lower with a higher interest rate, and they may not be as profitable. If the interest rate drops, investment projects are more have a higher rate of return, and the cost to borrow the funds to invest is a lot lower. So we are going to have a downward sloping demand curve that shows that at lower interest rates, quantity of funds demanded is relatively high in terms of quantity of funds, and at higher interest rates, quantity demanded should drop. Although I've seen people that borrow like 50% interest rate sometimes. That's a little bit ridiculous unless you really need the funds. So the general public will always borrow at some interest rates, at some X amount, and that's the cost to borrow the funds. You have to pay back the face amount plus interest. So here we have it. We have the demand for loanable funds, which is downward sloping. At lower rates, if the interest rate is zero, the quantity demanded for loanable funds could be significant. We have the supply of loanable funds, which is supplied by the public, the savers, or the financial institutions that supply loanable funds. And in equilibrium, the demanders of loanable funds, which are the consumers, the public, the firms, the households, the consumers, etc., meet the suppliers, which are people that save their money in financial institutions now in modern days time, or the financial institutions themselves supply loanable funds in the market. And the twin forces of demanders of funds and the suppliers of funds determine the market equilibrium interest rate here, the interest rate in equilibrium, and the quantity of loanable funds in equilibrium. So we have the equilibrium interest rate 1 for a specific quantity of funds in equilibrium. At a lower interest rate, the quantity demanded of funds will exceed the availability of the supply of quantity of funds, and vice versa. So only in equilibrium the transactions will take place. It's a little more complicated in real life, but here in equilibrium we have the demand for loanable funds in equilibrium with the supply of loanable funds available, and we have a determined interest rate. And this interest rate is going to be in the financial markets that is passed on to the consumers and so on. The interest rates are actually some specific interest rates that we have, very specific interest rates. We have the prime rate, the regular interest rate, the federal funds rate, the etc. There's several interest rates that are very important. Here we have in this case, it's just the loanable funds market interest rates, which is actually often referred to as a specific interest rate. Specific interest rates that determines the other rates. Here we have these situations for interest rates and how they influence other rates. So interest rates are determined by several factors, and they vary for various reasons. Often cases, the risk of the borrower could be highly risky, so the lender may be willing to offer the funds at a higher rate. If the loan matures at a later date or at a shorter date, the interest rate will be different. The maturity of the loan, if it's a really long time frame, it may have a different interest rate. If it's a short-term loan, it could have a different rate. So the interest rates could vary depending on the situation. The actual face value of the loan, if it's a high volume loan, you may have lower interest rates. For example, a mortgage interest rate, if it's like half a million loan, you may have 3% interest, 4%, 5%. If the borrower is highly risky, maybe even more. The loan size may determine also the interest rate, the taxability of factors. If the interest rate is tax exempt, the borrower will receive potentially a lower rate, and so on. Often cases, the taxability factor determines if you get some interest rates waived. For example, student loans, you can actually waive off the interest rate pay on your taxes if you have taken any student loans. So there are various reasons as to what can determine the actual interest rates in the market. But for the most part, it's actually very close to be the same standard for most consumers, depending on the conditions. So interest rates themselves, we have two different categories. One of them is the nominal interest rate, and the nominal interest rate is the interest rate that is determined by the forces of supply and demand in the loanable funds market. It's the face value of the interest rate. What the interest rate will be and the interest rate that you will get as a consumer or as a household or as an investor or as a demander of funds. That's the interest rate that we're getting from the market. Then we have the real adjusted interest rate, which is the nominal interest rate adjusted for expected inflation, meaning that the actual interest rate could be different based on the inflation rate for that year, or for the year, or for the country that we're looking and analyzing, or the market. Often cases, the inflation could be very high in percentages, so you wanna really adjust your interest rates accordingly when you're looking at the real interest rate of the market. So for now, we have the nominal rate and the interest rate. The nominal rate is the one that is determined by the supply and demand of loanable funds in the financial market, or in this case, in the market between the demand and the suppliers. And the real interest rate is adjusted for expected inflation. We have the equation for real interest rate. The real interest rate is the nominal interest rate that's stated in the market minus expected inflation rate. So for example here, if your credit card interest rate in nominal face value is 21%, your nominal interest rate, this is your nominal interest rate for your credit card, is 21%, and the expected inflation for that year is 4%. It's a little bit high inflation, 4%, and your real interest rate is your nominal rate, the nominal rate, which is 21%, minus the expected inflation, which is 4%. And in real terms, the real interest rate that is being paid is, in this case, 17%. 17%. Often cases, if the inflation is going to be high, the nominal rate will be set higher. So in real terms, they're taking a lot. So you could say that the financial banks are really cashing in on the interest rates, because inflation in the U.S. has been traditionally between 1 to 3%, sometimes even lower, sometimes zero inflation, and they still charge you 21, 25, 27% interest rates on credit cards. So in real terms, they're taking at least the majority of the nominal interest rate as returned to them. So next time you borrow from the bank or you use your credit card and you don't pay it back in full, you're paying back a lot in terms of high interest rates. Now we have two equations of how to calculate the face value of certain conditions of money or loan or funds in general. We can do the present value calculation, which is the current worth value of some future dollar amount that you will receive in the future. If you receive, for example, if you win the lotto, $1 million, $2 million, $100 million, and you can receive it 5 years from now, what is the present value today? For that, we need to have the present value, which is the amount of the conditions that you're going to receive, the amount of the money you're going to receive, divided by 1 plus the interest rate in the current market, times the number, times the n number of months or years that is expected to accrue from 1 to 5. So in this case, the present value formula, it's P present value of the amount divided by 1 plus the interest rate plus the number of days, months, or years that is accruing in that situation. This is only if you want to calculate the present value of an amount that you're going to receive sometime in the future. What it will be worth today. A lot of the times, people value the money now versus later because you don't know what could happen in the future. So if you win the lotto today and you're given the option to collect it, it's $100 million, and you want to collect that amount in a 10-year period, 10 years, every year you get 10 million and so on. It really depends. You want to calculate the present value based on the interest rate of the market and what is expected to be. You don't know what's going to happen in those 10 years. So most people will want it now, all of it, lump sum, minus taxes and minus the fees, because it's worth more now than it could be later on in the future, unless it's in some interest denominated accounts. And then you have the future value formula. The future value is important. This one tells you the amount of which some current amount today that you borrow or that you invest what is it going to be as it grows with an interest compound condition over time. And this is applicable to the majority of us, even the present value formula, but we're going to use the present value one because this is highly relatable. If you invest some X amount of dollars into an interest-bearing account, in the future it will be worth some X amount. If you have a credit card with some interest rate, in the future it's going to accrue because the interest rate compounds. Some mutual fund that you put in a financial market is going to grow. So this is referred to as a future value. The future value formula is the present value of the amount that you have, the amount, times 1 plus the interest rate to the power of time, however long it's going to accumulate in interest rate. And we're going to use the example of present value, the future value, to consider Sandy that it's a college student and she takes out $5,000 in student debt and student loans for 5 years. She's a freshman right now in college and she takes student loans for the next 5 years, and for a total of 25 years, $25,000 to pay for college. The interest rate is 7%, and she could have the option to pay it in 15 years, 10 years, but let's assume that she takes 15. Calculate the future value of her accumulated total loan debt. And the reason I say student debt is essentially is debt. If you're not collecting interest rate, you owe someone else interest. So we have the present value of the funds, which is $25,000, times 1 plus the interest rate, which is 7%, 1 plus 0.07 to the power of time, 15 years. So we're using 15 years. In this case, it could be compounded monthly, but we're using 15 years. 25,000 times 1.07 interest rate to the power of 15. Notice how the future value of those $25,000 that she borrowed to pay for college is going to be $68,975 approximately. It could be more. If she borrows more, she will have to pay more. And so on, except when she's in college, if she has subsidized loans. But notice how it is twice as much, 2.5 times more than what she borrowed. This is important because this applies to credit cards. If you borrow and you have to pay back in the future, if you buy a car, you end up paying more. If you buy a house, sometimes with lower interest rates, you end up paying more. So it works and it's applied to a lot of different things. And also, it's important if you have a mutual fund, $25,000 mutual fund, just switching it. If you, instead of you getting the debt, you invest $25,000 with 7% interest rates, this is what you will get. So it's important to know that you may be paying more in the future, or you could be getting more in the future, depending on how you use your loans or how you manage your debt. It's better to have investments and not so much debt where you have to pay interest. There's some good debt and there's some bad debt. Debt that you have to pay high interest rates on is significant. Investing in your college education is always good. You can't go wrong with the traditional way, because at the end you may end up being able to pay it or more. So it really depends on if this is a credit card. If this is a credit card, be careful. If this is for education, no, it's not a bad. Depending on where it is, it's important. Depending on where you're using that debt and how you're using that debt is what matters. Let's talk about economic rent. Economic rent in this case are typically referred to as rental income, residual income. It's payments that are in excess of or received for the ownership of some resource. Or in this case, the economic rent is a payment that is received in excess of the opportunity cost of using the resources. And then we have pure economic rent. Pure economic rent is a category of economic rent that's such payment is a factor that has a fixed in supply, and you receive all of the benefits from having that factor, which is a resource, factors of production. implying that the factor has zero opportunity cost and you cannot use it for anything else. The best alternative you have is use it there and collect rent on it. In this case, so think about economic rent. Typically, this is the definitions are a little bit complicated. Economic rent is when you're collecting rent on resources that you own, that are yours, that are owned by a certain individual, or you have some plant, equipment, factors of production, or resources, and the holder or the owner of these factors have clear understanding of their opportunity cost and a clear understanding of what those resources are, and they're collecting residual rental income on them. So here, the payment on excess of opportunity cost is if you have a resource and you know what the next best alternative of that resource is, and you know you can collect rent on it, then just collect the rent instead of using it for something else. The economic model of economic rent is as follows. So the total supply of the most commonly known resource is land. If you own land, in this case we only have a certain amount of land, it's fixed, so it's vertical, and you have the demanders of land. Those that demand to purchase the land, those that demand the usage of land, and we have the demand for land and the supply of land. The owners of the land have two options. They can either sell it, they can either lease it, or rent it. It's like three options: sell it, lease it, or rent it if they want to collect economic rent. Since we're talking about rent here, let's suppose this is lease or rental. So where the demand and the supply curve meet, that will determine the economic rent. This is pure economic rent. This is what the holder or the owner of the land is collecting, the rental income times the quantity of acres of land. This is the rent times the quantity they will collect, pure economic rent. This is the payment that they are receiving from supplying the land. Whoever uses this land has to pay an X amount of dollars to use it, to lease it, and if the demand for it increases, the economic rent increases it even more. If the supply curve is fixed, this is pure economic rent because there's only so much available. So the often case I relate this to real estate. If you own real estate, if you own land, if you own resources, plant, equipment, machinery, and there's demand for it, and you lease it out, the owners of the factors of production are going to collect rental residual income. And then, of course, they have some form of costs associated with it, so it may not be pure economic rent. There may be some economic rent, but it's better to have them than not. Here is assuming that they collect all of it, and the supply is fixed, but there's some costs associated with it to manage and provide the land. So in this case, if the supply curve is vertical with no associated costs, you have pure economic rent. David Ricardo is a famous economist introduced in the 19th century that used to talk about the importance of economic rent and economic activity. In the 19th century, people objected to his view on the increased prices of grain, like to eat. Some people argue that grain prices were relatively expensive because the price of the land was increasing, and other people argue differently. Some people argue that that the demand for the land was increasing, which in turn increased the price of the land itself and the grain. So the solution that a lot of individuals had was to lower rents so you can lower the price of grain, which will lower the cost to the farmer and therefore pass it on to the consumer in the form of lower prices. Land has always been one of the most important things to cultivate goods and services, to cultivate food, farming products, and to build houses and build cities. So if the land is accessible and it's cheap and it has low cost, it may be less costly to the public, and the final product may be less costly. If the price of the land increases, it increases the cost to the user, which in this case the farmer, and then they're going to pass on that cost to the consumer, and it will have higher prices. So there were arguments to lower the price of the rents, to charge them lower rents, so they can charge lower prices to the consumer. Essentially, it was because the demand for land was increasing. Demand for land was increased, fertile land, which was increasing the rental price of land, and the final product will experience an increase in price. So it's important because Ricardo was one of the most important economists of that time. That's about 200-300 years ago, but it has a basic principle. If land becomes expensive, the product that the land is used for to create increases in price. And if the demand for those products increase, as we saw on the curve, it increases the rental price as well. So if you can relate that to housing, the demand for housing increases, the equilibrium price will also increase, given that there may be limited supply. Now, David Ricardo, as an economist, contended to the idea that the rents were high because the grain prices were high. The actual grain prices were high, so he had to charge more rent. And the land is just a factor of the production process. And since it's fixed in supply, in order to charge a higher price for land, it will have to be explained with higher demand. So basically, saying that the high demand of the land made it more valuable, and it increases the price of the land, and it also increases the price of the grain. So landowners have no control technically over the perceived demand. When a lot of people want it, rents will be high. There's an increase in demand, the equilibrium price rises, and rents will be high in general, and then the price to the consumer will be high. So this is an important implication as to the value of land, the value of rents, and the economic return to the landowner or the owner of the factors of production. If you own the land and there's fixed supply or limited supply, and if the demand changes and it shifts up and it increases, the price of whatever land it is going to increase. So the final product's price is also going to increase, and the landlord can only control the actual land, but not the demand for it, because if there's a lot of people that want the land or they want the grain, the demand for it would increase, result in a higher price, which translates to the economic rent. If you have a lot of farmers running to purchase or to rent your land, there's a high demand for your land, and you have 5 different farmers, but you only have one piece of land, then the price of that will increase, and that farmer who gets it is going to charge a higher price. Same idea with traditional rental housing today. We have a lot of people that want to rent several units, and you only have one building, and there's a lot of demand for it. You increase the price. The equilibrium price is higher, so the rent to the consumers is higher in terms of what they got to pay, and the rental income to the landowner will be higher as well. So we need to keep this in mind. The supply curve of land may often be straightforward, vertical, fixed, but sometimes it's actually upward sloping. Like it has an upward sloping, which has a consistent increase in supply. The price could be a little bit lower. So most land have what is called competing issues. The farmland, if it's not used, it's not utilized properly, and it has a trade-off, meaning that it just sits there. It's an opportunity cost trade-off. It could be used for something else, to build property housing, to build shopping centers, to build schools, infrastructure, road development. If you have an empty building, it's just sitting there empty, and infrastructure is getting deteriorated. So most land have competing opportunity cost issues, which means they have other best alternatives to use the land for, and it's reflected on their price. The supply curve is upward sloping. Also, if individuals want the land for a specific purpose, and if it's upward sloping, those that want the land need to bid high enough to purchase the land, and also to attract more people that may want to use other land. So in this case, lands have to be used for specific purpose in different areas, and the buyers that want that land need to bid for it to demand that existing land. In this case, depending on where you live, when you're developing a city, so the supply of curve is upward sloping. It's going to be upward sloping, and the higher the demand for that land, the higher the price of it will be, and the buyer will have to bid higher to get that land if they really want it. So here we have the model. The supply curve is upward sloping, is not vertical. In this case, this is when you're expanding. So a particular piece of land will be upward sloping and has what is called competing opportunity cost issues that could be used for something else. If you have a land, you can use it for farmland, to open a shopping center, a mall, develop a community, etc. So those that are demanding the land need to offer a price to buy the land, and if there's a lot of buyers, the demand will shift up, and the economic price of the land will increase, or in this case, the equilibrium price will be rental economic price rent 1, and the seller of the land will collect that in income. So economic rent here is the economic return of the owner to own the land. Those that are demanding it need to pay that equilibrium price, keeping in mind that it could be used for something else, the space of land. And then depending on how much it costs to the landowner, you can have profit, which is our next subject. Profit can be differentiated into economic profit and accounting profit. In economic profit, it's equal to the total revenue, which is the total revenue of the units sold, minus the total cost. The total cost to the seller that includes explicit costs, the explicit cost of acquiring or maintaining the land, minus implicit costs, the foregone benefits that could have been collected, or the next best foregone benefits that are no longer obtained. So total economic profit, it's the total revenue minus total costs. And economic profits determine whether or not firms, whether or not buyers enter in or exit the industry, because essentially it's pure profit. If your revenue is greater than your total costs, and you include your explicit costs, which are all your explicit items, things that you explicitly have paid for an X amount of dollars, then you're accounting for all of your costs. And any implicit costs, implied costs, any costs that are implied, that are foregone, that have an estimated value. In your analysis, in your total cost, when total revenue is greater than total costs, that includes explicit and implicit estimated values, your pure economic profit is positive. So economic profit can determine whether or not firms enter or exit the industry. If there's economic profits, most people will want to buy the product. Profit could be uncertain. Sometimes profits are high, sometimes profits are low, sometimes profits decline, could be negative, and there's always the uncertainty that it could be highly profitable, but something unpredictable can occur and lower profits for the firms or for everybody in the market. So profits could be very high, could be very risky, could be very uncertain, but for the most part, very rewarding. Risk sometimes is an issue. It's a factor that can be insured against to mediate or to diversify the risk, but sometimes you cannot. And in certain situations where you cannot insure against certain risks, the owner or the seller incurs all of the losses and all of the risks. So uninsurable risks are changes in the economic environment, things that happen automatically, low demand for goods and services, If there's low demand, there's nothing really you can do but improve your product, make it different to stimulate the demand. This is the consumers demanding less of a product. Consider what happened to Blockbuster. There was low demand. The market changed. Netflix came about. Redbox came about. Everybody started buying Netflix and everybody started using Redbox. The demand for Blockbuster declined. That's an uninsurable risk. Consumer changed their preference. They were buying something else, a better product, a more affordable one, and Blockbuster economic profit declined. So that's a change in the economic environment. Often cases we have a recession where the market contracts. Something happens in the market and there's a recession, and you may not have the ability to insure against a recession if you're a small business, your small pop and shop. Is a victim of a recession. Consumers have no income; they don't come into your store. It's an uninsurable risk. The structure of the economy. Sometimes we have things that change. This is tied in with the structure of the movie industry and how Blockbuster didn't change their structure, and Netflix did online, and Redbox rent as you go, and lower the demand for Blockbuster. So they're kind of related. Government policy. Often cases businesses want to know which candidate will go into office because of the government policy that can either favor business or not favor business or have more regulations or less regulations, and that can affect business activity. In often cases we have profit and arbitrary opportunities. When you buy low and you sell high and you make high profits and everything goes well. And if you buy low and then you cannot sell, sometimes you may lose what you bought if the price is lower than what you bought it for. So everything goes well when you buy low and you sell high. That's a common saying, but sometimes it may not be the case. It may be an arbitrage opportunity where it may actually not have the effect that you intended to. Profitability and innovation is important. Often cases businesses that innovate, businesses that develop products that improve it, that make it better, that provide an experience, that provide something better, something different, have high returns. And typically entrepreneurs, innovators, creators take the opportunity, take the risk to implement a product, to introduce market changes, to produce the process, to make the strategy, the marketing, the campaign, and innovate a product and make it better and make a profit. And in those situations, it's pretty good because it moves the economy forward. And in some cases, we can have profits and potential losses that occur, and there are signals that may indicate that there could be some losses associated with certain events. So most of the time, resources tend to follow profits. If there's a lot of profits, you put more resources into it. If you have potential losses, you take away resources so you don't incur more losses. And losses cause resources to move from one area to a different company or to a different sector, and divert resources and turn them away from what's failing and put it in what's working, and essentially the other sector collapses and everything else improves. So in this case, resources turn away from losses. Financial resources, real tangible resources follow from things that are failing. They fall away and they go into what's making profit, and essentially that's where the investors go. Nowadays it's all about the online mechanism, putting all the financial resources there, because everybody's on the phone, everybody's on the latest technology. So there's a lot of research going into advertising online, capturing the consumer mind and attention. So that's important. Entrepreneurship ability, it's one of those factors that either you develop it, you nurture it, you create it, or some people are born with it. You don't need a college degree to be a successful entrepreneur, but you need to be really savvy and really a go-getter mentality to be a successful entrepreneur. Take on the risks, take on the initiatives, take on the obstacles, and make sure to succeed. So what makes an entrepreneur is more or less the character of the person, the integrity and the grit and the will to succeed against all odds. So in this case, the entrepreneurs operate within the market they are most familiar, or they develop, create, or innovate, or make some other markets better. They attempt to increase the number of trades within their market, within themselves, and increase the volume of sales within their activities. They take risks, heavy risks. They are innovators. They motivate people. They create teams, natural-born leaders, or essentially the developers of goods and services that other people will buy and the service that other people can benefit from. The entrepreneur must find a way to make things possible, even if there is no way to make things possible, but they make it anyways. So the consumer has to be willing to take what the entrepreneur is offering, or make them feel better. Consider Steve Jobs when it revolutionized the industry with the iPod and the iPhone. They produced a product themselves that satisfies some form of demand or unmet demand, or created demand for something that was not think of before. They make things more efficient, more cost effective, and facilitate trades. The innovation of the market is important, but I would say the connection to the people, making someone else's life better by improving a product or improving their lives in some way, is an important characteristic of entrepreneurs. There's good entrepreneurs and there's some bad entrepreneurs. There's good leaders and then there's some whatever social leaders that really move the market and the economy forward, financial markets forward, economies forward, also companies forward. And the entrepreneur is a fundamental pillar and a fundamental factor in society. Okay, great. We're going to end the session today with the discussion of a rapid highlight discussion of economic rents, economic profits, and also interest rates, and the importance of being aware of these factors as well. Thank you, everybody. Have a good night and have a good afternoon.